Hello and welcome to our channel JB Video Tape. Income tax. We are all living with it, right? Income tax is a big burden since which affects people a lot in both wealth and mental base, specifically the salaried persons. In more specific, middle class salaried persons. If government poses any rules or amendments on income tax, the latter will be affected more than the former. So, in this video, I am going to tip you some legal and legitimate ways to increase your take-home salary by choosing the correct tax regimes and exemptions. So if you are a salaried professional, watch it carefully without skipping. With no further delay, let's move on to the video. First of all, it is important to know about income tax slabs. So here are the table shows the old and the revised income tax slabs and the rates for the fiscal years 2021 to 2022. Old tax rates vary based on age groups, but in new, it is the same for all categories. Our focus is on salaried professionals only, so individual rates are only shown here. You don't need to pay any taxes if your annual salary falls below 2.5 lakhs. It is a basic exemption limit. Between 2.5 to 5 lakhs, 5% will be deducted from your income. With this new regime, you can rebate those amounts under the Tax Rebate Act. Good thing, right? If your income falls between 5 to 7.5 lakhs, 20% in older tax regimes, 10% in new tax regimes. For 7.5 to 10 lakhs, 20% in older, 50% in new. Most of the Indian middle class people fall under this category. And from 10 to 12.5 lakhs, you must pay 30% in old regimes and 20% in new regimes. Oh my god, that's a lump sum. For 12.5 to 15 lakhs, same 30% in old but 25% in new. Finally, for 15 lakhs and above, 30% in both old and new. So, what should I opt for? Oh, wait. Let's understand some exemption conditions opting for new and old tax regimes. As per the budget report, there are 70 deductions and exemptions that are not allowed if you opt new tax regimes. Some common important deductions are house rent allowance. So, if you live in a rented house, you can claim not to be taxed by submitting authorized proof to your employer. Next one is a housing loan. So, if you bought or plan to buy a house on a home loan, you can avail deductions on your home loan interest. Leave travel allowance. If you travel anywhere within India solely or with family, you can avail of deductions for that expenses. Children education allowance. You can claim deductions on your children education fees. Next one is a relocation allowance. Removal and recovery expenses for relocations offered by employers are not supposed to be taxed. Everything in the universe is made up of atoms, right? Atoms are both positive and negative ends. Like atoms, tax regimes also have some negative and a few positive too. Some deductions are allowed in the new tax regimes, so let's see what they are. Conveyance allowance. If the employer is not providing any transportations, you are using your own vehicle means that expenses provided by the employer will not be taxed if deductions are applied. Next one, travel allowance. Travel allowance. Unlike leave travel allowance, expenses occur only on employment related transportations or on transfer that will not be taxed. These are the exemption conditions for both tax regimes. Now comes your most awaited questions. What should I opt for? If you are a middle class taxpayer and your source of income is the salary only, you can benefit the most from this new tax regime. And if you have more than one source of income, that is, if you are a high income earner, you can go for old tax regimes to get a maximum benefit. If you have investment in tax schemes like education loans, life insurance or home loans, and if your investment amount is greater than 20% of your total income, then you must go for the old tax regimes to help you for higher deductions and more savings on tax. So if your investments with less than 20% of your total income lead to higher tax liability, so stick with the new regimes is better for the people whose investment is less than 20%. Bit confused, right? Okay, let's understand clear with an example. You see the table which compares old and new tax regimes of Rahman with 10 lakh rupees as annual income. Tax saving instruments he spent rupees 1.7 lakhs under PF and stamp duty charges, 13,000 in medical insurance and 15,000 against a home loan. So taxable income reduces to 7.5 lakhs in old tax regimes. Due to such no deductions are applicable for new tax regimes, gross income is equal to taxable income. Coming to tax slabs, in the old regime, 62,500 is the income tax for old regime and 75,000 rupees income tax on the new regimes. With 4% cess on income tax, in total, Rahman needs to pay 65,500 rupees if opted for the old regime. Otherwise, he must pay rupees 78,000 as a total tax on the new regime, which is good. For sure, the old regime caused his investment on tax earnings is 25% against his annual income, which exceeds the critical limit of 20%. And most important one, you can change your tax regime option every year. But once you opted, you can't change it for a year at any cost. Okay, we have come to the end of this video. Hope you got some useful tips and tricks to keep more money in your pocket. Okay, then post your comments in the comment box. If you have any doubts or suggestions, post them in the comment box or send us through the mail. We'll respond for sure. Okay, let's catch you up on another video another day. Until then, bye.
Subscribe to our channel and click the bell icon to get notified.